Hello. I'm making a video today on the corporate finance, and I have started to try to be a little more organized and a little clearer about some of the corporate finance page. So this is the corporate finance collection. Now all the models have a lot in common. They all have the key part, which is getting some historic data and then making sure it can be really automatically updated. And then also working carefully about projecting the return on invested capital, with one exception, that's a financial company. And then I try to work on terminal cash flow and DCF model in a different way. I hope it's not the same way. I hope it's a little bit different. I think it is. And then I've got a bunch of models here. One on Karachi Port Authority, which was just overbuilding like crazy. I was so worried about it. It's a oligopoly. There's one or two ports that compete, and when you got a lot of excess capacity, it's going to kill you. And the same thing happened with this ancient company called Kitty Hawk Airlines. Oh my gosh. And then there are other cases where I've talked about this, where you got really high returns, and this myth that you can keep high returns in a competitive business, not like Apple, who can get you addicted to their stuff. And then I've got some with changes in the cost structure of the industry and cyclical industries and all that. I try to put different cases. Now, the one I'm going to talk about right now is this beer company. I talked about it other cases. But the big deal here is using the interpolate function, getting a stable terminal period, getting the right normalized terminal period. You go in all these DCF models, nobody talks about really how to normalize and get a good terminal period. And then I've got a simple model, and then a chicken producer in Ramallah, food company in U.S., this First Solar company, an airline company, Mongolia mining, Pakistan, Karachi, other corporate models, including one in Singapore and Lafarge, and one in Slovenia. And they all have different things. They all are pretty similar in one respect. Now, I thought the most comprehensive one, really, it doesn't have a good dashboard. Oh, no. Okay, here's some of the features of this. It has a graph, of course. On the graph, it's crucial to graph the history versus the projected and kind of go through some of the accounts. Here's their volume of sales, and oops, that's just the history. And then we put the EBITDA, the history, and projected. Okay, and then and I don't know if I like this even, and then the notepad. Now when it's doing that, it's kind of doing, there's a lot in here. And what I did to get this graph to work is I tried yet a new method. I keep changing my methods. But I just copied, just here, all I did is took the text from the page that has all the assumptions, and there are a whole lot of blanks and all that. And then I hate this. I don't hate it, but this kind of remove duplicates. Instead of that, I used our union function, and it worked. And it took the blanks out. And I should make a function, I guess. It wouldn't be a difficult function. Just sort all of the accounts, okay? Or not even sort, just take and make a function that remove the blanks. I should have done that. I was lazy. And then once I had that, well, it comes from, which page? It comes from this page, the free cash flow page, assumptions page. Okay, and then we just take all of these. This has got the history and all the assumptions. So the way the graph works then is, once you have these titles and they're in the same page, you just do a little match and find the row number of the title. And once you have the match, you can then put your little drop down boxes in and everything else, and then do an index on this. So you put a match of the title here, and then you do a little drop down box, get a code number, and do an index, make an index on this to find which is the row number associated with the match. It's kind of a match and index in an indirect way, and then you double index because you're using the index in the page. So you can see how to make the graph. And I made a scatter plot too, so you can kind of, if you want to see what the something like the admin cost is compared to the sales, so you can do this kind of thing to try to figure out what's fixed and variable, and it never works, unfortunately, really. SG&A, I don't know if I have SG&A here somewhere, COGS, where's I don't know if I even have it. SG&A is a percentage of sales, okay, whatever. I can't find that. I was trying to do SG&A as a scatter against the revenues. I didn't do it. Sorry. Okay. Then here's what I really want to show you. This is why I hopefully want to kind of, I don't know if I'm making a good enough video on this. But this, we get our basic parameters for our valuation, okay? Our WACC, our terminal growth rate. And then I put the difference between the WACC and these people who I worked with say, RONIC, return on new, incremental invested capital. How fancy is that? Okay. And then we put in, we transfer all these variables, the EBITDA, the tax rate, the depreciation expense. I also got the net working capital divided by EBITDA that I'll talk about just in a minute. And then we put a different, a terminal year, whatever terminal year we want. And then I have, okay, we need some data for some terminal kind of assumptions. So we go down and get our explicit cash flow. And when you get the explicit cash flow, just don't take the NPV, take the NPV and raise it times 1 plus WACC, raised to the 0.5. So you assume the beer sales don't all occur on December 31st. Then they occur in the middle of the year. And you better do that also with the terminal value. Okay, and then we get now, there I say, first get stable EBITDA, and then get stable CapEx, and then get stable net working capital, and do the whole thing. Go to that terminal year, and try to figure out what the stable values are for all of those things. And that's the tricky part. Before we do it, let's see what happens. If I put in, this is the share price of the company. So as usual, you can put your downside case in the downside case. And as usual, I should tell you that for me, let's not put NOPAT, let's put return on invested capital. For me, making a corporate model is all about forecasting the return on invested capital. So this wasn't a big decline, certainly not. But then we get depending on which method we use, I'm going to focus on the old-fashioned growth method, we get a difference in value. Now, here's the big thing. You then have to say, okay, in the long run, what is here's our WACC. If we make less than the WACC in the long run, I must have some data tables in here. Shoot, maybe that's what's slowing me down. I thought something was. Okay. And then we can see, if we change and make this, let's say we have this absurd assumption that in the long run the WACC is equal to the cost of capital. Look how big of a difference that makes. Okay. I think, well, maybe it didn't make as much difference as I wanted. I'm looking at this valuation. So this valuation is about the stock price. And then if we push it down to, let's say, the cost of capital, Then we got all the way down. This was 100 crowns, not quite 100. Yes, it was. If we push it up to where I said it was before, that long run return on invested capital versus the WACC is a big deal. And then let's say we put a low number in, okay, and that's adjusting the first one, that's adjusting EBITDA. And if we push this and make this converge faster, oops, or converge slower, then we get a different valuation. Now, oh, if I should make it lower. So let's make it lower, so we're pushing it down, and then if I converge faster, okay, then we get a much lower rate than if you converge slower. And you can say, oh no, this formula with the value driver does that. Bull, it doesn't. It's a horrible mess, that formula. You have to do it explicitly. Okay, and let's see how we do that. Okay, so this is a little more advanced, I hope, than your normal old model. So you go to the regular kind of explicit period, and you go to your terminal value, which is totally flexible because you can make 2024, 2021, whatever. You can make a terminal value switch, okay? Uh-oh, I hope I did. And you make sure everything is all flexible. That's our FAST rule, our flexible thing, our religion. And then we go and we get the, where am I? Okay, the stable EBITDA. When you go up here, this is the regular EBITDA, and if you put different parameters in, we get a different level. And let's see how to get that stable EBITDA. And to get the stable EBITDA, you go down past your little tables and your enterprise value, and the bridge between the enterprise value is another thing I should talk about in this video, but I don't want to run out of time. Okay, and to get the stable adjustment, I just say, okay, let's start with our last year. Oops, start up here with the last year and use the sum if on the true. Just use a sum if, a wonderful thing. Sum if, and sum if on the true and false. There's only one true, and that'll get your terminal value. Get your terminal ROIC there, return on invested capital. Put your stable ROIC here, and then use the interpolate lookup, and get it to go down and stabilize. And you have to put how many years it will stabilize. And then get the NOPAT and see how that stabilizes. And then the next thing you have to do is put in some kind of function that says, okay, we need to levelize this out. I use levelization a lot in electricity. We get a levelization by putting the NPV. We take the NPV of the NOPAT and then take the NPV of just one and divide that, and you get the levelized amount. And then you have to adjust that by the tax rate to get it gross of tax, because NOPAT's after tax. And then you have the EBITDA in the terminal year and the normalized EBITDA. This time it didn't make much of a difference, did it? But that's such an enormous assumption. If you have bouncing around ROICs or something, you want to make sure that you have a reasonable level. And you don't want to use that other one, that other formula. Then you go to the next one, CapEx. And you talk about the ratio of the CapEx to depreciation. I hope I have this. Do I have somewhere? I hope I have in this thing the history of the CapEx to depreciation. Okay, that's, it kind of bounced around. And in the terminal value, you want to get the right level. And I put a whole half chapter in the book, my book, about this. Okay, but I'm going to put the ROIC back. If we put a different asset life, if you make the asset life longer, it gives you a lower ratio of stable capital expenditures. And here's kind of what you do with that one. You go, and I should have maybe put the historic, sorry. the historic, you put the depreciation expense in first with the old sum if. You put a historic growth, a future growth. That's your terminal growth rate. And that's our little depreciation. And then you put your depreciation life. And I put in this CapEx to depreciation this thing that computes the stable CapEx to depreciation. This is pretty boring because it's a pretty boring company because you're not growing. If you're growing faster, if you put a faster growth rate, let's put a faster growth rate. Let's assume that for some reason we have a much faster growth rate. I'm going to put a much faster one. Let's put 4% or something crazy. This company would never grow at 4%. That would be an absurd terminal value to put in. Don't think I'm advocating that. But then we get a much higher CapEx to depreciation. And if you put a different historic growth in, that's a confusing one to think about. But think about it this way. Let me try to explain it, and I'm pausing because I'm going to have a problem explaining it. But let's say we stop growing, and let's say we had a really fast growth rate in the past. If you had a fast growth rate, that means your depreciation from that old growth is going to come way down. Where's our, if I put a really high, let's put, hang on, before I do this, I left it, let's put 1.3 as our terminal growth rate. So we have a CapEx to depreciation up here. Our CapEx to depreciation, where is that? This is the big number. So you're going to take your depreciation in the terminal period, multiply it by that, and get a CapEx, a stable CapEx. And the CapEx in the terminal year was not very different from that. So we didn't, it happens to be the adjustment wasn't very big, but it could be big. And the final one we'll make is a working capital. Now, if I put a historic growth rate, let's put a historic growth rate of 20%, something crazy. Historic growth rate, let's put, okay, I'm just put it with the thing. Then our CapEx to depreciation goes down to 1.1. Let's put a negative, let me see if I can put a negative to that. And then what happens to our CapEx to depreciation? Then it goes way up. So if we have a fast growth rate, our depreciation was going to go down and our CapEx is going to go down because we're going to retire faster than we replace. Okay? You almost have to think about kind of population theory to get all this right. And that's a different subject for this. And then we, on the working capital, we say, okay, in terms of working capital, we look at the net working capital change and make an adjustment based on the net working capital change. It's the formula is you take I should have shown this formula better, but it's the net working capital to EBITDA multiplied by the EBITDA, multiplied that by the growth rate divided by 1 plus the growth rate. You have proved that in a lot of other places. And then we have an adjustment to all our normalized things, okay? And then you can adjust for all this. And you should put even the deferred taxes, make an adjustment here. But that illustrates, so this file is supposed to illustrate a lot of the fundamentals and a lot of the little complexities of a corporate analysis, and it's got a scenario analysis and all that. Now, when I get the historic data from the PDF, I put in all these little switches, and I'm really careful about trying to dissect the balance sheet, and this one wasn't so hard to do, frankly. Other ones have things like derivative assets and pension. That's pension liabilities isn't hard, but the some complicated things that you have to think about. And we get invested capital, and we can figure out. Then once we get the invested capital, and I work hard on getting the invested capital and reconcile that, either taking a direct method from the assets or indirect from the financing, and then there accumulate some other stuff Okay, and then you can take the invested capital, subtract out the equity, add back the minority interest, and that's the bridge between equity value and enterprise on a book basis, not on a market basis, I know. And then you can reconcile that by saying net debt cash and net debt minus cash, and take away, in this case, we didn't include associated investments or minority interest, add that back, other liabilities, take away the net assets, add the net assets, excuse me, held for disposal, and the assets net of liabilities, and you get the same thing. Do a lot of reconciliation on the balance sheet. That's hard. I'm just trying to illustrate that. Take a look at this model. You're supposed to just take a look at it. And then you can look at all the trends and then work through all of the kind of, take the history and try to make some assumptions, and they had the beer volumes and all that. Now in the scenario analysis, I suggest putting all these time sensitivity things. A lot of that times in other models, put that right in the model. I think my new philosophy is these should be done all in the scenarios, all the stuff. Just make all the, so then you could add a sheet to somebody else's and do the same thing. This isn't very artistic. Oh no, but that's enough. So that's an introduction, and I think I'm gonna put this as an introductory vid, and I've got LBO stuff, but that's not important. It's really the DCF model and making appropriate terminal values for the DCF model, and not using, because I've got other videos explaining why you should not use this horrible you know what I'm talking about, the value driver, 1 minus G over ROC divided by WACC minus G. That is not a good thing to use in the terminal value, okay? And then we put it with multiples as well, but, you know, and make it a little presentation, and we put the bull case here, and in the bull case things go up, but that's an unrealistic ROIC. That's the real lesson. You better present the historic and projected ROIC. Now, there was a write-off here of intangible assets that distorted the ROIC, which is a pain. You can make an adjustment to that. That's another subject again, but I'm stopping the video. Whoops, here you go. Wow, 22 minutes. Bye.